R.C.Brown, lead manager of the MFM UK Primary Opportunities Fund, is with us today to discuss the day after tomorrow. Oliver, good morning.
Good morning, Mary.
Oliver, the fund has noticeably outperformed its sector peers and its performance benchmark since inception. What's driven the fund's performance over the years, as well as more recently?
It's our primary opportunities process. That is investing, at the stage that companies are typically raising money, or, in some instances, buying existing listed shares when there is what we call a secondary sell down. So where perhaps founders or management are selling down a large block of stock, and as long as we understand why they're selling and who's selling, and we're buying it at a discount, then we will consider an investment as well for those purposes. But it's just that consistency of our process. We are buying in at a discount to the prevailing market price. This gives our investors downside protection. What we expect is for those shares that we've bought in a bit cheaper than a typical investor. In time, that discount will unwind. So we are adding alpha when we are using our process. And we're typically buying in free of stamp duty and free of commission, because when a company issues new shares, they're newly issued shares, so there's no stamp duty on them, and the brokers don't typically charge commission. So we're not adding to the costs either of the fund. And as we all know, fund costs do act as a drag on investment performance, and we don't have that to a large degree.
Do you find that allows you to be more active?
Well, we're unashamedly active. If we see a primary opportunity and a company that we want to invest in, and we think it's going to improve the quality of our portfolio, and of course that we're going to make a positive return on, then we want that in our portfolio. So we're not afraid to sell a company in our portfolio. Now, it may be a company that is underperforming, but more typically it's a company that is perhaps in a similar sector to the company that we're wanting to put into the portfolio. And that keeps our balance and the well-constructed nature of our portfolio. 2020 was a year where we saw a lot of primary placings, so that is existing listed companies that were raising fresh capital. And that is very much the bread and butter of what we do. But we did see a small number of IPOs come to the market. And all the ones we invested in produced, strong returns for us. Companies such as Phonics Mobile, which is a payments processing company. We've mentioned Quay previously, and Bytes Technology, which is a software, an IT company that again is seeing strong growth as a result of companies having to spend more money on their IT, with more people working from home, and they're very well placed to continue expanding their business.
Amidst the current world market instability, why do you consider this fund to be a staple UK holding for a client's portfolio?
We see our fund as a diversifier to those other UK funds that an investor may hold, because of our primary opportunities approach, which gives investors access to part of the market, fundraisings that are not typically available to the retail investor. We have a first mover advantage because we are nearly always investing at the stage a company is raising money. So we understand why the company is raising that money and what it's going to do with that money, and obviously we then monitor it very, very closely and carefully. And it's really important, we're not buying blind in the market as other investors do. We're not going into the secondary market in normal circumstances, and that reduces the potential for nasties to come out of the woodwork further down the line, and it's those nasties that really can be damaging to portfolio performance.
Thank you, Oliver.
Thank you, Mary.